Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everybody, and welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and I'm delighted today to have Colin King of Circle City Capital Group with me. I've been following Colin for a very long time, both to his subscribing to his free Substack and his paid Substack, and we overlap on a ton of stocks. He's interested in spinoffs. I'm interested in spinoffs. We've exchanged a ton of Twitter DMs over time, but this is the first time that we've actually spoken live. So, Colin, so happy that you could make some time to chat. Thank you for coming on the podcast.
Yeah, thanks for having me, Rich. I appreciate it.
I would love to hear a little bit about your backgrounds.
Yeah, I'll try and give you the 30,000 foot view, quick and dirty story. So my professional background, I started Big Four accounting. I was a CPA, wanted to be an accountant, all things accounting, really didn't have an interest in finance or the markets or anything. I kind of stumbled into investing and that led me down the path of taking the CFA. Took the CFA and went to work at a long only shop here in Indiana on the buy side. It was about a 400 to $500 million asset manager. And the first day I walked in, my boss handed me a copy of Greenblatt's "You Can Be a Stock Market Genius," and it was like, oh, this is where I'm meant to be. So that was kind of the style of investing that I was brought up on, was that special situation type focus, value focus, looking for uncovered stuff. I spent 6 years working at that firm, met my current business partner. We both had the notion that we wanted to be entrepreneurs, but we didn't want to start a business from scratch. So we were looking at private businesses to buy. And we spent a couple of years tossing over or turning over a lot of stones, looking at things to buy before we bought our first company in 2018. And I've talked about that on a number of other podcasts, and it was kind of a mixed bag operationally. But we sold that company and then basically redeployed the proceeds into a handful of other acquisitions over the last 6 years. And now we run that business full time. And then I still like follow the markets very closely. We don't manage any outside money or anything like that, but it's all our own funds that we deploy. So that's the story, quick and dirty.
That's great. That's great. And I just want to give a quick plug for your podcast interview that you did on the Acquiring Minds podcast. There was an episode where you're interviewed. It's like an hour and a half podcast. I loved it. From midnight deliveries to a $28 million hold co in 6 years. First of all, great copy with that title. It's very enticing. But I just loved hearing that story because I just viewed you as somebody who was interested in stocks, and I didn't know that you had this other life as basically an acquirer of small businesses, and that you were building them up. You might have covered this in another podcast, but at what point did you quit your job as an analyst to go full time into the
Yeah,
Circle City Capital Group?
Yeah, that was in Q4 of 2019. Q4 2019, so great timing. We at the time, my partner and I, we kind of made this decision like, all right, if we're going to do this full time and have enough cash to pay ourselves something, cover our debt service, and be able to continue reinvesting back into the businesses, then we would need to like, deploy a bit more capital than we were maybe comfortable with, at the pace that we were going before that. So in Q4 19. We bought three companies in basically like a 3 month span of time. And that was big enough to like basically say, okay, great, we've got some steady state cash flow that we can come on payroll, jump on with both feet, and then run from there. And it's been the sort of a slow grind higher ever since then.
And how do you split your time? So it sounds like you're spending most of your time looking or managing the private business, the whole co, but at the same time, you are pretty prolific in terms of covering spinoffs. So
Yeah.
how do you manage your time? How are you able to do so much?
Yeah, my investing time is like my cherished nights and weekends, free time in the morning. If I'm up early and the kids are still sleeping, like I'm looking at stocks if I can. And I still manage, my portfolio and some friends and family. And so I have pretty good systems in place when it comes to investing, just things I've carried over from when I was working on the buy side. On the private business side, I think the biggest challenge is just trying to prioritize the things that you're doing, right? If you've got four different companies that you're running, several brands within each one, then the context switching can be enormous, right? So like if you've got one day job or one thing that you're focused on day in, day out, you may have a backlog of 100 good ideas that you want to go do. And if you've got four businesses with four brands each, and you want to go look at stocks, which has a ton of businesses out there, right? Like that backlog just it gets pretty cumbersome. So, I try to be as good as I can about like ranking and prioritizing the things that I'm working on. Fortunately, our largest company is at a pretty good scale where we've got, a management team in place. I'm more of an advisor, de facto CFO, if you will, to that company. And then same for our other businesses. We've got a pretty good division of labor between myself and my partner from an ops, marketing, and finance standpoint. So my passion is really looking at financial statements and working through the finances of businesses, big, small, public, private, whatever. So that's really where I spend most of my time when it comes to working in the companies that we own.
It's funny you mentioned the switching costs at the time, switching your focus from one company to another, and it's hard to prioritize what to look at. I struggle with something similar in the spinoff world because I basically look at all spinoffs. And so by
Yes,
default,
likewise.
I'm not covering any one sector. And so instead of getting really deep in one sector, I'm an expert in the spinoff dynamics, but then you have to get up to speed in the individual new spinoffs that are taking place. Then
Totally.
you have that, and then in addition, you have the private companies. So you definitely have your hands full. I'm curious, how do you allocate your capital between public opportunities and private opportunities?
Yeah. When I first started out wanting to do this, I bought into the Buffett cliche thing, like let's build a Berkshire Hathaway and have a big investment portfolio and private businesses and blah blah blah. And it really didn't play out that way. And the private business side grew a lot faster than I was anticipating when we set out to do this. So the public investing side is maybe more of a glorified PA at this point, right? And it's all personal capital, so we can invest in whatever we want in really pretty small dollar amounts. Now, we have talked about like, okay, do we want to go out and maybe bite off bigger chunks of smaller companies, right, and take some activists or work closely with management teams of like microcap type companies, but I wanted it to be like a 50-50 barbell portfolio, but the private business side is just like way, way, way more valuable at this point.
That's a good problem to have.
That's a good problem to have. Yeah. Although I still love stocks. So it's like, oh, come on, catch up.
Would you ever, and I know we were talking about this prior to going live, that one of the attractive things is getting SBA financing because you can get really high leverage and as
Yeah.
soon as long as you have a stable business, all you have to do is pay down debt and you can really accrue value to equity value. Would you
Yeah.
ever have cash, kind of like a Berkshire model, where you have cash at the holding company level that you guys manage and invest in spinoffs and other attractive opportunities? Or is the focus of the cash right now really going to just pay down debt, service debt, maybe make other acquisitions?
Yeah. I think that could come into the picture at some point and really the SBA. I mean, it's a pretty tremendous program, right? If you're trying to buy a small company and you don't have, you're not independently wealthy, you can actually go do something and make something happen. Um, but on the private business side, controlling that cash and at the end of the day, you can roll up your sleeves and actually like influence the cash flows in that business and the revenue in that business where I don't know that I would believe you can just roll up your sleeves and like work harder at looking at stocks and make the outcome better for you necessarily. So there's that control aspect of like, ah, man, if I own and control these cash flows, like I can actually do something with them potentially, depending on what your skill set is and what you bring to that situation. Um, Internally for us, where we're at in this, well, we've been at this for 6 years, and we've got like kind of a staggered chunk of debt in each of our companies. Some of them are closer to fully amortizing, some of them are repaid, and some of them still have a few years to go. So I think we're getting close to that crossover point of like, yeah, all right, it'd be interesting to go deploy, some capital to like a microcap situation and take a decent chunk stake in a company and work with that management team. Yeah. Finding good managers is always the biggest challenge. So if you find a public company and they've already got a good management team, like I would love to partner up with someone like that who just says, "Hey, we could use your skills in finding an acquisition or structuring a deal or helping develop, a marketing program for our company or something, like that would be really fascinating for us.
Yeah, that sounds super interesting. Like we talked about, there's so many incredibly cheap micro caps, and it's one thing to be trading at a really cheap price to free cash flow multiple, but it'd be a totally another thing if you could actually take that business private and have access to those cash flows. So that
Yeah.
seems super interesting.
Yeah, it's given me such a unique perspective on like these are real companies. Like, some of them are similar in size to our company, maybe slightly bigger, maybe even slightly smaller. And knowing the inner workings that goes on in a business, like, maybe I'm a little bit of a crusty cynic at this point, but like there's so much more to it. There's so many more dynamics and variables that go on behind the scenes than just like plugging in a 40% gross margin and saying, oh yeah, this thing's worth 10x EBITDA and you're good to go. It's just a lot harder of a battle than that behind the scenes.
It looks really easy in Microsoft Excel, and then you see how the business actually works, and you realize it's a little bit more complicated
That's
than
what I
maybe you
love about
initially
Excel.
thought.
Yeah.
So in terms of spin-offs, I know you pretty much look at every spin-off, it
Yeah.
seems to me, and I really appreciate the research that you put out, but I would love to hear how you think about spin-offs, and then also if there are any overarching lessons learned that you've really taken away through your experience investing in spin-offs.
Yeah, I do. I love that space. I look at just about every spinoff that comes out, if not all of them. I usually don't catch them. I have kind of a screen or a filter that sends me new Form 10 filings regularly. Um, but yeah, I look at every spinoff. I really love the ones that have like weird spin ratios, like Zimvie. When Zimvie came out, I want to say it was something like 1/100th of the market cap of Zimmer Biomet. And I was like, oh man, this thing does not stand a chance. And it came out at like 30 or $40 and quickly fell to, teens and then ultimately got to like $5 or $6. So I really love those crazy spin ratios and even some that are like closer tied to each other. So back in the day, Alliant Tech Systems, I don't know if you looked at that one years ago, the ammo manufacturer that's now Vista Outdoor, right?
Yes, I
They
know
spun
Vista
off
Outdoors.
or
Yeah, didn't know they
yeah,
were.
they spun off Orbital ATK, which was their space business, and it was like a 50-50 split. So like it was $120 stock or something like that. And if you bought one share, you were going to get two equal shares, like same size market cap. And so that was just a really interesting situation where like, yeah, the spin ratio made it really, really fascinating. So I love those like weird, wonky spin dynamics. My old boss at the firm that I used to work at, the fund, he made this comment several times over where he's like, these are unseasoned securities, right? Like they don't have a trading history, they don't have a pattern of earnings reports, and you don't have history with them, right? And so coming out of the gate, depending on how they issue guidance or deal with carve-out financials, like it can be a really messy, murky, minefield laden situation, right? So like if a management team comes out and they're not good at communicating, like here's the carve out numbers and you can't rely on past because none of the interest expense was embedded in there, right? Or our tax situation's changed. Like you can really walk into some potholes if you're like, oh yeah, EPS is $6 a share, and you're like, oh wait, no, it's actually five because they forgot to tell me about this, that, or the other. So that unseasoned nature of spinoffs, I think is really, really interesting. And you can get some good opportunities if you catch the ones that do a bad job and then pick them up later after they've kind of like, course corrected a bit. I think that's what happened with ZIMV. I don't know if you follow that one pretty close.
That one is fascinating, and I think is still fascinating today.
Yeah, I've definitely taken some off the table. I essentially like doubled down on it at $5 after they like blew up in late 2023. Took a bunch off the table as the rumors were coming around them getting bought out, but I still own some. I mean, it's a decent business with what I think is a pretty good management team. So yeah, I don't know. I still own some of that one. Yeah.
Yeah, I've looked at that one, and it seems like if you look at it versus the dental comps, it looks cheap. And it looks like if it is acquired, it will be acquired for a nice premium to where it's currently trading. But the thing that has kept me on the sidelines to date is that the fundamentals of the business just don't look great. Like revenue is still shrinking. I don't think margins are meaningfully moving higher. And so the whole dental market just doesn't seem that strong. So it seems like it's a very cheap on a relative basis and very cheap on a takeout. But the fundamentals are, on that one are kind of holding me back. But I love what they did. I mean, when they sold their spine business, that was
Yeah.
unbelievable. Because I think when that spinoff took place, those businesses, the spine business and the dental business, they had never been together. Your comments on lessons learned from spinoffs totally resonate with me. I think a big risk factor in looking at spinoffs is when a company the initial guidance, because if you're basing all your financials on a certain EBITDA estimate, and oftentimes these companies are very highly levered, and then the EBITDA estimate is off by 20%, that can have an obviously a massive impact on your
Yeah.
equity value and your enterprise value, fair
Yeah,
value. So
those debt situations are really interesting too, right? Where like they pretty rarely have spinoffs with net cash balance sheets. I mean, the Curbline Properties one's kind of interesting. Sandoz and the generics, they were spun from Novartis. Maybe this was a year or two ago, and they were spun with a clean balance sheet. But then you've got like the super levered, like we're just trying to jettison this with as much cash coming back to the parent as possible, right? Like those situations seem way more common. Seem way more common.
100%, 100%. One name that comes to mind, Garrett Motion. I don't know if you took a look at that one, but
Yeah.
that one, Honeywell was spinning off that business basically at the peak of the auto cycle, peak of the economic cycle, with massive debt loads, super cyclical business, and then they had billions of dollars worth of asbestos liability. So that was a little dicey.
Yeah, I like referring to them as having no chance. There's just no chance. Yeah.
Well, let's I know a name that you've done a lot of work on, and I've certainly appreciated the research that you've done on it, is a recent spinoff called Magnera. So if you wouldn't mind, would love to hear just a little bit of an overview of what Magnera is and why it's interesting.
Yeah, it's the thesis is pretty simple, and this was a spin from well, it was a spin merge situation from Berry Global. So Berry Global, plastics packaging company, and they had this non-wovens business in the health and hygiene market, making like wipes, hygiene wipes, some industrial products and things like that. And at the same time, they were merging with Glatfelter. GLT was the ticker pre-spin and it was a business where the cycle was effectively peaking pre-COVID and going into COVID and then just completely reversed course to a cycle bottom. I mean, it was like all pick your poison from all the COVID headwinds that all these companies were facing, commodity markets, inflation, supply chain, whatever, and they were hit with all those things at the same time, which just destroyed results both for Barry's segment and for GLT's business. So they timed this spin where like it's effectively closing at a point where industry fundamentals are bottoming out, right? So they put a bunch of debt on it too, right? At this hopefully industry bottom, and really the math is such that if they come out and they realize the synergies that they're calling for, when the cycle starts turning in their favor here in the next few quarters, then the upside could be pretty significant. I think there hasn't been a ton of work on the potential downside scenario, but they've painted a pretty good picture of the industry fundamentals turning in their favor. So the stock is really, really cheap. And they've got a management team coming over from Barry. Barry is a very, very experienced acquirer and integrator of acquisitions. So the fact that they're coming in kind of lends some confidence in being able to hit those synergies and saying, hey, we're going to cut these costs, probably consolidate their CapEx budgets, right, to get some savings on that side too. So it's a pretty interesting situation where most other stocks in the market have run pretty good here lately.
And in terms of so right now, I mean, I'm looking at that one. Full disclosure, I own the name. I'm recommending it. I think, correct me if I'm wrong. Do you own the
Likewise.
name as
Yeah.
well?
Yeah. Likewise. Yes.
Yeah, so I think the equity upside, if they hit their numbers or they get back to prior peak numbers, the stock looks absolutely insanely cheap. When you think about what's causing the downturn right now, and it's kind of like a post-COVID downturn. Was it really just destocking? So people bought a lot of products, a lot of wipes, a lot of diapers, things like that, and then just destocking over the past couple of years, or what's really driven the downturn?
I actually think it's mostly raw material costs. So the I can't remember if this was on a call that the Berry management team did, or maybe it was the a GLT call, but I think it was the Berry CEO. He likened it to more of a paper business, right? Like the pulp and paper businesses that are out there, where they have these like vertically integrated. We make the pulp, paper, and fluff, and then sell it into the personal care businesses that have the brand name products that are out there. So if you were to go pull up a chart of like pulp, paper, fluff prices, like right, like they line up pretty well with when they peaked out from an EBITDA standpoint on both of those businesses. And then the irony is that GLT made some acquisitions like right as those EBITDA numbers were peaking in 2021. And I think there's a really good comp out there. The that was also taken private in 2021, probably based on those peak multiples, and that was a company called Domtar, Domtar. It's no longer public, but they were a pulp and paper producer, and they had a personal care hygiene business, right? And they sold that hygiene business for like $920 million or so to private equity in 2021 at maybe 8.5x EBITDA at the time. So everybody was doing deals in 2021, like right as those commodity prices were in their favor, and then they all unwound. But fortunately, they're kind of stabilizing now, such that they should see that EBITDA turn the corner here soon.
That's really helpful. Do you get a sense that the business has bottomed? Because I've looked back at the past quarterly financials for both the Glatfelter as well as the berry portion of the business, and it looks like the business has bottomed, but we haven't quite seen an uptick yet. And I guess
Yeah, I
that's
think
kind of
it's
the million
still.
dollar question. How highly confident are we that the business has really bottomed here?
Yeah, I don't know that they've found the floor yet, so to speak. And I think that's one of the risks is like everybody's saying, oh, it's really cheap on an EV to EBITDA basis, but it's like, oh, what EBITDA number are you actually using, right? Like how much credit are you giving them for synergies and the cost cuts that they've done? And GLT has like some pretty they're pretty heavy-handed when it comes to ad backs too, right? Like it's a pretty long list of stuff. So I think off the top of my head, I don't remember if they've if from looking at the latest quarter's results for both Barry's business, pre-spin and for the GLT business, but I think they're still kind of comping down year over year. I think GLT's or EBITDA numbers are starting to come back, but yeah, I think they're doing this. I don't know if they're this strategic about it when it comes to doing these spin-offs, but like it's coming out right at a point where it's you kind of get a free pass for that first quarter or two, and it should be during that period where they start to see that inflection coming through. It was kind of a similar situation with like Sandoz and even Viatris, which was formerly Mylan. They merged with the Pfizer's generics business, and they tried to do it at a time where like, okay, yeah, we know the results are going to be really bad for a while, but they come out on the other end of it. So I don't know, it could be a quarter or two away before you start seeing that turn the corner positively. Or what do you think?
Yeah, from my perspective, I mean, so the way that I got comfortable with it, and we'll talk about free cash flow generation and CapEx requirements, but the way that I think about it is the business is trading at, I think on a trailing 12-month basis, I think the latest numbers is they've done like 388 million of EBITDA.
Yep.
And so that's like a no synergy number. And then their synergy number is like 450 million of EBITDA. So the way that I'm thinking about it is that it's basically trading at like a little bit above 6 times, kind of no synergy EBITDA. And theoretically, I mean, I don't know if they're going to be able to get $75 million of EBITDA, within a year or two, but theoretically they should be. This is a much larger company. They should be able to get some synergies. So that $388 million of EBITDA estimate is probably pretty conservative. And then the stock's trading at a little bit over 6 times that number. And then
Yep.
the way that I think about it, and it'd be interesting to get your take on valuation, but there's a lot of private equity comps, companies that have been taken private at multiples much higher than where the stock is currently trading. But I think the best way to think about it is to just look at where Glatfelter used to trade. And if you
Mhm.
look at it, it used to trade, the lowest it really traded was around 6 times EBITDA. So it seems like it's trading at a kind of a trough multiple on trough earnings.
Yeah.
And I don't know if there's going to be a little bit more downside to the earnings, but it seems to me like it's a pretty good a pretty good setup. And then the other thing is just on an absolute basis. And so we're going to talk about CapEx and how much CapEx this business requires. But the latest guidance from Magnera is they're going to spend 2 to 3% of revenue on CapEx. And if you run the numbers, and you calculate interest expense and taxes and you get to, I don't know what your free cash flow estimate is, but like I can get to the business generating, 100 million to 150 million dollars of free cash flow, depending on how many synergies you actually count. And then so this is for a company with a market cap of, I don't know, 600 or 700 million dollars. So it definitely
Yeah.
looks pretty cheap on an absolute basis. But how are you thinking about all those dynamics?
Yeah, so I just was pulling up my numbers as you were talking. And I'm like right in the ballpark, and I think they said it was 388 million or so of TTM EBITDA combined, 50 million of synergies, and then 22 million of run rate cost savings from actions that they had already taken mostly on the GLT side. So that's like kind of the backdrop. And I think where I shook out on the synergy side was I liked the fact that Barry management was coming in and kind of leading that effort because theoretically they should know what they're doing. They even had one slide where they were like, "Yeah, we are experienced in doing this, and that's why we feel good about these synergy numbers." Um, I think you're right. I got to a similar free cash flow number. It just depends on where CapEx shakes out. They're talking about a CapEx number that's like really pretty low, like historically, like something they've never lower than what both of those businesses have ever really done in the past. So I and they've hinted at this on calls, right? That like I think they're deferring some stuff to try and get leverage under control over the next 2 or 3 years. So, I don't know that I love that, but at the same time, if they come out and put up some cash flow, repay some debt to the tune that they're talking about, then I think the stock will respond to that. Yeah, I think the biggest risk for me is I really like to look at leverage based on like debt to free cash if I can sometimes. And if you're talking 130 million of free cash and gross debt is close to 2.1 million, like that's a pretty levered business, right? So maybe they've got more that they're talking about being able to do on the CapEx side to like make some short-term moves there, but I think that's why it trades where it does, right? I mean, the thing is pretty significantly levered. And if they don't put up good cash flow numbers, then I think the thing will, take some body blows.
Yeah, I mean the downside case. So I think Glatfelter is the best comp, Glatfelter. And my take is that this thing should trade at a higher multiple than Glatfelter because it's a much larger business. It's going to have
Yeah,
much larger, much higher margins, and its debt has later maturities, and the cost of debt was
yeah,
refinanced to be much lower. So you can make the case that this thing should trade at a higher multiple than Glatfelter. And so if you
yeah,
apply the EV to EBITDA multiples that I'm talking about, the lowest Glatfelter historically traded at was around 6 times. It's pretty much right there on no synergy EBITDA. But
right.
if you do that same analysis on an EV to revenue basis, you got a little dicey because I
It,
think the lowest Glatfelter traded was like point six times EV to revenue. And obviously, if you're assuming a point 0.6 times revenue on this business, like there's very little equity value. So I think
right.
that's the downside. That's the downside
Yeah.
scenario. I
I think it comes down to that same setup we talked about earlier, right? Is like how do these companies navigate through that spin process and how good are they at saying here's what we're going to do in that first period and they're kind of showing us what this EBITDA number is and then layering in the synergies for it, but they're not like explicitly giving guidance, but they've kind of dropped some hints I think there's one slide in their deck where they talk about how much deleveraging they'll be able to do in the first 2 years post spin. Like, so they've dropped some hints, but I think it comes down to like how do the numbers look in that initial 1 to 2 quarters post spin, and then what sort of guidance do they give to say here's where we'll be able to get within 2 years' time. And if they manage that situation well and communicate that guidance well, then I think the stock will do well.
Yeah, and then you also have the classic indiscriminate selling situation
Yeah.
where basically Barry shareholders own 90% of this company post spinoff. And
Yeah.
so,
Yeah.
like one thing that I try to do, and I'm sure you're very aware of this too, is how many shares have traded, right? You don't want to
Yep.
buy ahead of the heavy waves of indiscriminate selling pressure. But we're at a point right now where 100% of the share count of Magnera has turned over. And so, theoretically, I think that indiscriminate selling pressure has pretty much ended. At this point, it's going to just depend the fundamentals of the business. Like if the business has bottomed and they're showing good results and generating good free cash flow, then I think the stock could re-rate. But if they're actually going to guide to lower than $400 million of EBITDA or lower than $388 million of EBITDA because of
Yeah.
unforeseen issues that came up, I think that would cause the stock to take another dive deeper.
Yeah, I think that's right. I mean, I think the spin dynamics were definitely significant. The 110 spin ratio. I like those setups, and I've been trying to like compare it to the price that I was looking at it initially, right? When GLT pre-spin was maybe like a buck 75 or something like that. And at $20 today, that's a buck 53, right? Pre-spin comparison. And it got down to what did it get down to? Like 17, $18. Like so call it $1.30 compared to $1.75 pre-spin. So I think it got punished pretty good compared to that pre-spin price. And now it's in that territory where people are saying, all right, what are results going to look like and what are these guys going to be able to do in the next 2 years to make that balance sheet look a little better?
Exactly. Yeah. The good thing that they have going for them is that the debt, I think that the nearest maturity is like 20, I think it's might be 2029. And then they have another slug of debt that's
Yeah,
not going to come due until 2031. So that's good.
yeah,
And that's the other nice thing too. Like even if they do have a disaster of a quarter and the equity takes a big hit, like the business doesn't have any imminent maturities. So that will allow it to kind of
yeah.
hang in there for at least a couple of years.
Totally. And again, I mean the Berry pre-spin Berry Global, formerly Berry Plastics, like they have been basically a publicly traded private equity roll-up for more than a decade, right? So I mean these are guys that know how to operate at a sustained 3.5 to 4.5x leverage situation and navigate through that. So I guess I'm more trusting of the Barry management team coming into the picture than I would be if it was like, hey, let's leave it up to the GLT guys. I haven't followed that name as closely.
Yeah, how do you think about management when you're looking at spin-offs? I tend to kind of take the same approach where I like the management team to have come from the parent company. And my thesis, and I don't have any like academic research or or detailed research that I've done to back this up, but my sense is that the if the management team comes from the parent company, generally they know where the skeletons are, they know where the low-hanging
Yeah.
fruit is. That's my theory. What's your experience been with management of spinoffs?
The only time that I think it's a really big tell is if you've got a really big parent, and I really am maybe less so in this particular situation because it wasn't like a top C-level executive from Barry coming to run this business. But if you've got a really big parent and a small spin, and you've got like a C-suite executive coming to go run the spin, like that's pretty interesting to me. So like 10 years ago, there was a spin-off called Symmetry Surgical. Did you ever look at this thing?
I didn't
Symmetry
know.
Medical? Yeah, Symmetry Medical was like a contract manufacturer for medical devices, and they were getting bought out, and they were spinning off this tiny little like surgical instruments business. It was like a $50 million microcap spinoff, and the CEO of the big company was like, "Yeah, I'm gonna go run that little thing," and I was like, "Oh, that's kind of fascinating." So I was like, "Okay, I think that was the crown jewel of the business that was getting spun off, and they were just kind of selling off the rest of it to this other bigger company. That's kind of interesting, right? Where you've got the CEO of a big company who's like, yeah, I'm gonna go run this. I'm gonna go run this little thing. I don't think I've seen that too frequently. I think that was the case in the Vista Outdoor spin and maybe a couple of other scenarios, but otherwise, people try to hone in on like, oh, what's the management team doing? Are they staying with the spin? Or are they going with with the RemainCo or whatever. But I don't know that I've tracked that as closely.
How did that spinoff end up killing it? That little
Yeah,
spinoff with
it spun at like $7 a share, and then ultimately got bought out at like $13 or $14. I
got
want to
it.
say maybe like 2 years later.
Got it. Yeah, so nice return there. So the Site Center spinoff, it's kind of a similar dynamic where the management team, the existing management company, basically said, "Hey, we're going with the Curbline spinoff. We're basically going to liquidate the RemainCo." Curbline is viewed. It's a smaller business, but it's like we talked about earlier. It's a net cash balance sheet. They have a bunch of dry powder to make acquisitions, and it seems like it's a really interesting opportunity.
I that's one I haven't taken any action on either Curb or Site Center, but I've been watching both of those. Like I like the idea of owning a liquidation, right? I mean, just the markets run really, really hard. And if you know you've got an active seller of assets into a strong market, like that's kind of fascinating. And they've gotten to the point where they're basically unlevered at the site center side. And then on the curb line side, they've got this huge pile of cash as a REIT, which is like really uncommon, not even really uncommon, like super rare. And so they have this huge pile of cash to go deploy. It's not crazy cheap on like an NOI basis or anything, but the fact that they can take their time and go execute that over like 3 to 5 years, I don't know, it kind of sounds like an interesting place to hide out in a market like this.
100%. Yeah, it's really like not the game that I usually play because it seems like it's a really high quality company with a really long, good secular tailwinds. But then
Yeah.
at the same time, it's like you said, it's not cheap. So like I was really hoping that the Site Center RemainCo would sell off, and it sold off a little bit, but I don't think it's too
Not
interesting
much.
at the
Yeah.
at the current valuation. But
Yeah.
but yeah, I agree. The curb line looks super interesting, but it just not really my game. I'm looking for like the more Magneras where it's like the little
Yeah.
dicey business, but super cheap and could be a
Yeah.
massive,
Can you take
2x
take
or
a little
3x.
quality out? I'll pay a little less, and then yeah.
Exactly. Well, Colin, this has been awesome to chat with you. I'd love to have you on the podcast again when there are more spinoffs that we're both looking at. But in the meantime, where can folks learn more about you, both Circle City Capital as well as your Substack?
Yeah, so I write a weekly post on stocks at valuedon'tlie.com. It's a Rasheed Wallace ode if you're familiar with Ball Don't Lie. So valuedon'tlie.com. I just wanted to get in this process of like turning over a stone every week, and it helps me with my own idea generation and like sift through my watch list and everything. So it's meant to be like a jumping off point for the investment research process. So that's my kind of like public investing side of things. And then on the private business side, our company is called Circle City Capital Group. So we've got a website, circlecitycapitalgroup.com. My email is Colin, Colin, at circlecitycapitalgroup.com. People are free to reach out to me if they want. Shoot me a note. Happy to chat about private businesses or public companies or anything in between. Yeah.
You gotta explain to me the Rasheed Wallace quote because I thought it was a Shakir reference. So the hit, the song "The Hips
Ah.
Don't Lie." I thought it was like a,
Oh
a
yeah, yeah.
knockoff of like "Value Don't Lie," and I
No,
heard on
it's
another podcast that it was a Rasheed Wallace reference.
yeah.
So you gotta
So
explain to me this reference.
So Rasheed Wallace had a saying, if you basically Rasheed Wallace played in the NBA, Detroit Pistons, and so at the free throw line, right? If you didn't earn the free throw and you missed the free throw shots, he'd say "ball don't lie," right? So "ball don't lie" is a NBA reference to foul shooting. Yeah,
Got it. Okay. Very, very interesting. So it's not a Shakira reference. Okay. So
yeah.
Rasheed Wallace
Glad
actually,
we could
I
set
think he
that.
played for the Celtics towards the end of his career, and I think he
Yeah.
lived briefly in the town that I live in. So,
Nice.
that's hilarious. Well, Colin, thank you so much, man. This was a ton of fun. Really appreciate you sharing your insights, and look forward to chatting again soon.
Likewise. Thanks, Rich. Good talking to you.